Welcome to TheoTRADE. This is Don Kaufman. It's March 19th, 2025. Just about 5 minutes to go to the cash close here on this Wednesday, this Fed day. Volatility, well, look, S&Ps right now are up 63, but they are way off the highs. And I got to tell you, after the Fed, I mean, what do you got left? I mean, look, the Fed's done. Now markets are going to face nothing but volatility. Mark my words, tonight's video here, well worth watching because I'm going to show you exactly why there is going to be some very tumultuous volatility in the very near future. Let's start with the fact that, well, what did Jerome Powell say? You know, it's more or less what he didn't say, and he didn't say very much. In terms of the Q&A portion, things got a little interesting. The bottom line simply comes down to Powell turned around and actually said because of the current administration, there's some stagflation, maybe a little wild uncertainty. And that's where I'm going to tell you right now, there's just no question, unequivocation, you are going to see some heavy volatility hit this marketplace because the Fed right now is actually left kind of in a lurch like the rest of us. Again, the Fed's done, okay? They're removed from the equation, and you saw this immediate kind of burst to the upside in the marketplace. Right now, again, with just moments left in the trading session, you've given about a third of that back. I mean, the irony is that if you looked at yesterday, in fact, if we go to the SPX, okay, this is the welcome to the SPX. This is basically where we were yesterday. It's where we were Monday. Okay, we're trapped in stuck in the middle with you in terms of volatility, but there's a really kind of key point to look at here inside of the SPX, beyond the idea that we're just kind of stuck in the middle with you. But it's that this marketplace is still, anticipating a lot of volatility in the remainder of the week. And the remainder of the week, you've only got Thursday and Friday, and you have this just gargantuan, it's almost 140 point expected move this week. The actual move right now, and I'm just showing you, as I say, kind of stuck in the middle with you. But, yesterday we were down 60. Today we're up 60. You laugh, you cried. Okay. The point I'm trying to make is if you take a look at this line on your screen, people, that's where the week started. It's literally where the week started. We've moved like what, 30, 35 points to the upside this week. So it's been pretty meager move to the upside. And I know that people are like, it's a continuation of the rally and so forth. I guess the ironic twist to that, it's not really a continuation of the rally. On Friday, where we closed, that's what this line is that I'm drawing on the screen. That's where we closed on Friday. We're only about 30 handles higher, which is, again, a rounding error basically in this marketplace. Okay. I'm going to go a little deeper, though, than just showing you some price action in here, because I just don't think price action is going to do it. I am immediately going to jump over to the bond market. And one of the reasons I'm like, this doesn't exactly look good, we're starting to see some capital move towards the bond market. There's a couple of different reasons capital can move to the bond market. But in this instance, I think it's actually moving in there as a little bit of duck and cover. Today, isn't really going to be the litmus test. I think that's going to be tomorrow. I think tomorrow, if you see the bonds really start to rally again tomorrow, get nervous in a hurry. Get nervous in a hurry because it's capital actually rotating again away from some of the equities. But we started to see that just a little bit today. This move is like, but the bonds are only up like 11 ticks. They're up a lot more than that from some of the lows. So when the Fed announcement actually came out, we're trading, 116 and 23 ticks. Okay. And now we're trading 117 and 19 ticks. And for those of you that do not speak tick geek, that's almost a 1 point move. We're just shy of like a 1 point move, which is kind of a big boy move to the upside. Okay. On, again, what amounted to kind of like a nothing announcement out of Jerome Powell, only to say that there's incredible uncertainty. By the way, the one thing the marketplace doesn't like, of course, is uncertainty. So the bond market, again, from my perspective, still points to considerably more risk. Now, if people look at the VIX, the VIX has actually dropped. Well, we got through, it's a big tamale, right? So, Jerome Powell hit the main stage and the volatility dropped. I get it. But what are the volatility futures saying? Like what's, we're not going to worry about individual stocks. Individual stocks are just, getting battered around like toys, literally toys in this marketplace are individual stocks. Okay. What you want to look at, especially into this cash close. So that is it on this Wednesday here. But what you want to look at into this cash close is volatility structure. And this is much more interesting. The volatility structure, and that is the volatility futures, have actually completely flattened out, which they are absolutely not like sounding the all clear here. Not by any stretch of the imagination. And that's what's important. As I said to you, I'm going to show you like hands down, like, look, you may continue to rally a little bit today. You may continue to rally a little bit tomorrow. Okay. But you are not out of the woods. Okay. Not by a long shot. If you were, the volatility structure wouldn't be flat. What they're basically implying is today's risk is just as great as, May's risk is just as great basically as 91 days from now. So if you looked at like volatility, normal volatility, okay, when I say normal volatility, what I mean by that is the future, okay, would hold more risks. Why? Because 91 days versus, for instance, 28 days. Okay, what can happen in 91 days is considerably greater than can happen in the next, for instance, 28 days. So volatility normally looks like this. If you were to chart it, lower here, higher here. Why is 91 days higher? Because more time is more uncertainty. That is not the present case. The present case, okay, is that the volatility structure is flat. In fact, it's slightly inverted. Okay, meaning that today holds just as much risk as 91 days from now. And if you start to really like think about that, you're like, that's completely backwards. And it is. Okay, so the rally that you've seen over the last couple of sessions is not taking us out of what this backwardation. It's like we refuse to go into the night quietly. That is one of the big ones as well. Even with volatility down, look, volatility should be down. As I said, you got through like the big tamale, he hit the main stage and that's it. So volatility is down, but volatility is not sounding the all clear. Okay. Moreover, people are still looking at like, VVIX and so forth, and the VVIX subsided, the exact same thing. The VVIX, the volatility, okay, of VIX, it should subside. Those that needed to hedge, okay, got the hedges on, and then it subsides after that because like, okay, like that hedge really helped us, it got through, so they start to relinquish hedges. If we go into another bout of sell side activity, yeah, it'll come back up over here, but that'll be kind of in hindsight. What you got to look at right now are bonds. You got to look at volatility structure. Okay, couple other points to be made with this. So the S&Ps, as I was saying a moment ago, closing up just about 65 points. All right, here's another one, okay? And this one, it's still baffling. It's still baffling, and I continue to come back to this every video I do, whether it's the weekend update, whether it's the Wednesday update, every weekend, video, I'm talking about this incessantly, and that is correlation. And I wanted to, on this, Wednesday evening, also talk about correlation. It's still not there. There was a point today where the S&Ps, they're ripping. They're up, 57, 70 before pulling back here a little bit. And they were just ripping. And the advanced decline line, okay, was nothing. It's, a little better than 50-50 over here. That is going to keep us in this wildly destabilized situation. As I continually reiterate, we're not home yet, okay, with sell side activity. We're not done with volatility until we actually see the marketplace, okay, just basically snap into this heavier correlation. You start to move as a unit, okay, or we continue to be wildly volatile. The irony of that is that at the peak of volatility, that's usually when the marketplace is going to correlate, okay? And that's also, okay, very often when I say the peak of volatility, it's just that, it's the peak of volatility. Will correlate, okay? and then and only then can things kind of calm down, okay? And the market can then move forward. But we are nowhere near it. I keep stressing this advanced decline line in here. Last, but definitely not least, the same place that I started over here, back to the SPX. 139 point move was exactly the expected move, basically 140 points. Okay, the markets, they got through. Okay, what you're thinking is, well, it's a critical amount of risk. Do not forget for 1 second, we're in a triple witch. And that triple witch unto itself, okay, is going to create a lot of adversity in the coming days. So strap in for some more volatility, okay? Define your risk, getting into trades, get in, get out, get on with it, okay? Do not substantiate too much risk. We are still in a heavy volatility situation. Just remember, Fed's done, okay? Now it's a clear shot, but that clear shot is facing, okay, nothing but volatility. Thanks everybody for joining us here at TheoTRADE. Have a wonderful evening. Bye-bye.